This week in economics on the 7th of October 2018, beaming from WBRN Radio and on the Bostonred Network. Very interesting week, an interesting week for the bond market, and an interesting week for the employment situation. We partner with Cranston Analytics as we normally do, and broadcast from the Jerry Pippin broadcast booth. Jerry Pippin was our late broadcast partner of more than 15 years. Nonetheless, here we go. We'll set this piece up from Reuters. U.S. job growth, cools, get my words out here, and the rate of redundancy or unemployment drops to 3.7. And in the broadcast, we'll talk about the unemployment rate, scarcity of workers as an inflation enabler. One of the things we'll be talking about in this broadcast. We'll look at the numbers from Baker Hughes. GE, Baker Hughes is now part of the GE family, and see how many rigs are out there. And the forecast from the New York Fed, Atlanta Fed, as to Q3 growth. And where oil pricing will go, evidently the Russian Federation and Saudi Arabia will intervene next month when the sanctions on Iranian petroleum kick in. But India will buy in November from the Iranian government, the Islamic Republic. So those are some of the high notes here that we'll be talking about. And of course, at the same time as the bond market is moving up, the stock market falls globally after the report. And of course, Treasury yields, and we'll talk about the Treasury yields and some of the trade-offs there from the Reuters people. We sort of went through here. A decade, this is one of the headlines of U.S. economic sluggishness, they call it, may have just snapped back to normal. And I think I'll start with this, and then I'll go to the employment situation from the Bureau of Economic Analysis. Nonetheless, for a solid decade after the collapse of Lehman Brothers touched off a global financial crisis, there was good reason to think the U.S. economy remained broken, from skepticism about the health of the labor market to tepid economic growth and the morbid rate of interest paid on Treasury bonds. In a heartbeat, it seemed to change this week, adding facts on the ground to the Fed chair, Mr. Powell, growing a portfolio of historically rosy and extended periods of super low unemployment, redundancies, moderate inflation, steady growth. It came after Amazon moved its minimum. They haven't quite gotten there yet. That'll be next month, possibly to $15 an hour. And Amazon accredits Senator Bernie Sanders, the progressive that ran for president in 2016, in our campaign for 15. Now, it's worth noting many of the supporters of DJ Trump are looking at a minimum of $21, $22, which is the basic rate. In Pennsylvania and Ohio, 31,000 steel workers are negotiating raises, and Wilbur Ross, he is the Secretary of Commerce, is saying they will get some relief there. So things are looking up. On Friday, the 3.7 unemployment rate is a 49-year low, continuing a run of employment growth that many analysts, including the Fed, have long expected to slow. Well, yes, wage inflation is creeping higher. That's from Russell Price. He's a senior economist at Ameriprise Financial Services in Troy, Michigan. That's outside of Detroit. There's no question the job market in the U.S. is possibly at its best in a generation. No question of debate about that. Job reports have become a inflation report. Treasury bonds rose on payroll reports, with the benchmark 10 note touching its highest since 2011 after the depression. And of course, the market slipped. It's an old-fashioned supply and demand. Amazon's decision to raise starting wages above the board was perhaps the best example. Fed and other officials had anticipated for a while. The lack of available workers would prompt that. Now, it's important to note that in some markets, Amazon has already raised the rate above $15 an hour, closer to $18 an hour. So it depends on where you are. While productivity growth is faster, then is your opportunity to share some of the extra output with your workers. That's what's getting wages higher. That's from Vincent Reinhardt, chief economist at investment manager Standish, and he's former head of the Fed's Monetary Affairs Division. Even former skeptics have now become open to a recent rise in productivity may turn into a trend, drawing comparisons with the great moderation period of growth in the 90s. Well, the 90s was a totally different time. We had at that time the dot-com boom. That was basically a contrived move. We, of course, were in information technology at the time, and the Internet was new. It was enabled by the Internet, and anything that had Internet in it. Now, we weren't talking about, at that time, machine learning, although we were in machine learning at Cranston, but it was not something out there. Artificial intelligence, we got into that in the late 80s. Anyway, nonetheless, the dot-com boom, products that were being built associated with the new Internet. Most people remember, at least my age, and in their 50s, the great trial of O.J. Simpson of Los Angeles. Well, that was telecast not only on cable, CNN primarily at the time. Fox was, I think, in its infancy. But on the Internet, we had user groups at that time. We did not have Facebook nor Twitter. But that was heavily attended by people that, heavily focused, I should say, by people that watched the trial from the tap of Judge Ito's gavel till the last closing argument of the day. And, of course, at night on like court TV, those kinds of things. You don't hear about them anymore, but very much at least. But they were very popular at night, and people would go online to discuss it. AOL at the time had a discussion group, so they were all over the place as far as that was concerned. And people were buying into Internet companies, forming Internet companies, and, of course, then the bottom fell out. But that just spectacular growth to the economy. And the Internet boom brought upon various other kinds of booms in the 90s and rolling on basically until the election of 2000. And that year, recession set in. And there was another recession that the country was pulled out because of the 9/11 boom. Homeland Security was created. Jobs are created in the military-industrial complex. And thus the next boom, we're moving down here, was the real estate boom. So we've been on booms before. Now, is this current situation a boom? Well, we'll look at the numbers here, and it depends obviously on which sector you're in as to where it will go, and also we'll look at job growth. But the situation with job growth in September, I believe is the month we're looking at, is that in many of the markets, all the available workers that can be found or are needed. Now, there's two different things going on here. In some markets, the only jobs available are the ones that are not very desirable. In other markets, there are just not any workers around to fill those jobs. Our companies are just not, that have vacancies, are not advertising them anymore. So there's an interesting situation there. We won't go into the natural rate of unemployment as applied to certain Pacific metropolitan areas, states, etc. We will get into that in another broadcast coming up. So let me finish this article up here. To pay for the tax cuts and bump in defense spending, the Treasury is floating the market with bonds at a near record pace, with the gross issuance of bills, notes, and bonds in August topping $1 trillion. To sell those bonds, the Treasury may have to pay a higher rate. Meanwhile, a major consumer, the Fed, whose purchase of 3.5 trillion assets during and after the that was called quantitative easing or accommodation after the Depression, it's now shrinking that by $50 billion a month. Now, the Fed is using its continual increase in rates to counter inflation. You'll have some, even as unemployment dives for years to come below levels not seen since the 60s. Now, we hear this quite a bit, but the problem is in the 60s, a totally different economy was dependent on manufacturing, no longer the case, and at the same time was a much smaller economy. It was not globalized, and we at this might take issue with people that point to that particular time. It's not a very good time, and I remember in the 60s we had recessions, ups and downs in the situation. Didn't have depressions, but had recessions, and also remember that the Vietnam War was going on. That was the equivalent generator at the time, the military-industrial complex, with the types of weapon systems that were being used, and the number of people involved in the Y effort at the time. Also, you look on the other side, those were people that were not available for the workforce in the U.S. But, and also, you had the baby boomers, which were coming into being there, and you had a surplus of labor, and at the same time, in the 60s, you had legacy of the apartheid economy that African Americans, Latinos were not integrated into the economy. In the early 60s, Dr. King was marching. So some of these things are reflected there. You get around to 1968, but in 1968, Richard Nixon had wage and price controls because he had been part of the Wage and Price Commission. From the Cleveland Fed there, Mester, divergent U.S. economy, and warn could also be mean a strong dollar and fewer exports and growth. No doubt about that. Some of the risks, the return of volatility of return for savers, of which pressure benefiting workers may also pose risks. They are the risk of most of a more normal world. The economy is performing excellently well, at least relative to recent history. Now, that is from Joseph Leveger, the chief economist at NASIS. Never heard of them. But not the boom of the late 90s, but doing pretty well. Yeah, and this is one of the situations as to what you're comparing it to. Let's go to the employment, the Bureau of Labor Statistics. Their release here, the employment situation, and their analysis. This is on for September of 2018. The employment rate declined to 3.7% in September. Total non-farm employment increased by 134,000. Job gains occurred in professional and business services, in healthcare, in transportation, and in warehousing. Hurricane Florence affected parts of the East Coast during September. Reference periods for the establishment. Of course, we visit the establishment household surveys. Response rates for the two surveys were within normal ranges. The Bureau of Labor Statistics released an estimate of employment and unemployment on October 19th. The household survey. Unemployment rate declined 0.2% to 3.7% in September. The number of unemployed persons decreased by 270,000 to 6 million. Over the year, on the unemployment rate, the number of unemployed persons declined by 0.5%, or 795,000 respectively. Amongst major groups, the unemployment rate for adult women at 3.3%, for Europeans at 3.3% also declined in September. The jobless rates for adult men at 3.4%, for teenagers 12.8%. For African Americans also declined here at 6%, for Asians 3.5%, for Latinos or Hispanics 4.5%. Showed little or no change over the month. The long term, those jobless more than 27 weeks, roughly half a year, was little changed. These individuals accounted for 22.9% of the unemployed. Now, that's a very interesting situation there, which means the needle is not moving. The labor force participation rate remained at 62.7, and the employment ratio at 60.4 with little change. The number of persons employed for part-time economic reasons, sometimes referred to as involuntary part-time workers, increased, and this is something we look at all the time, 263,000 to 4.6 million. These individuals would prefer, obviously, full-time work if they could get it. In September, 1.6 million persons were marginally attached to the labor force, essentially unchanged from a year ago. These individuals were not in the labor force, wanted or were available for work, and have looked for jobs sometimes in the past 12 months. Amongst the marginally attached, there were 383,000 discouraged workers in September, unchanged from a year earlier. Discouraged workers are persons not currently looking for work because they believe there are no jobs out there. Quite a few of those. The remaining 1.2 million marginally attached to the labor force in September not search for work for reasons such as school attendance and family responsibilities. The establishment survey, a total non-farm payroll, rose by 137,000 compared with an average month of 201,000. That's over the past 12 months. In September, job gains in professional and business services, healthcare, and transportation, warehousing. Employment in professional and business services increased by 54,000, has risen over 560,000 a year. Healthcare employment rose by 26,000. Hospitals added 12,000 jobs. Employment in ambulatory healthcare services continued to trend up 10,000 over the year. Healthcare employment by 302,000 people. Employment in transportation warehousing by 24,000. Job gains in warehousing and storage at 8,000. In courier and messengers at 5,000 over the year. Total employment in transportation warehousing 174,000. Construction trended up in September, 23,000. The industry has added 315,000 jobs over 12 months. Employment in manufacturing continues to trend up. They added 18,000, reflecting gains in durable goods industries over the year. Manufacturing has added 278,000 jobs, with 4/5 of the gains in durable goods components. In mining, now mining, they put the petroleum industry in there. In support activities, mining rose by 6,000 over the month, by 53,000 over the year. Leisure and hospitality, little change over the month, a negative 17,000 prior to September. The industry had been on a modest upward trend. Some weakness in this industry reflects the impact of Hurricane Florence. Employment showed little or no change over the month in other major industries: wholesale trade, retail trade, information, financial activities, and government. The average work week for all workers on private non-farm payroll remained unchanged at 34.5. In September, in manufacturing, the week edged down 1/10 hour to 40.8. A little overtime built in there. Overtime edged down 1/10 hour to 3.4 hours. The average work week for production non-supervised workers was unchanged at 33.7. In September, the average earning for all workers rose by 8 cents to $27.24. Over the year, the average earnings have increased 73 cents, or 2.8%. The average hourly earning of non-private production and non-supervisory workers increased 6 cents to $22.81 in September. A change in the non-farm employment for July was revised up from 147,000 to 165,000. The change for August was revised up from 201,000 to 270,000. With these revisions, employment gains in both August and July were 87,000 than previously reported. You'll see some of these revisions, but both months, well, not August, was below the average, roughly 210,000. August was 270,000. July, 265,000. You're going to be going up and down. Our seesaw model reflects that. Let me just dive down a bit here. Civilian and non-institutional employment. This was numbers in hundreds of thousands. 255,582 in September of last year. In September of this year, 258,209 here. The civilian labor force at 161,000. That was 1 year ago. It's 161,776. The unemployment rate last September in 2017 was 4.2. It is now 3.7. And now we're going down categories here. And of course, this is seasonally adjusted. We won't go all categories. But for 16 and older, at 4.2 was last year. At 3.7 for adult men, 20 years and older, was 3.8 last year. It's 3.4 now. For adult women, 20 and over, 3.9. Now it's 3.3. So that has went down. For teenagers, 16 to 19, it was 13. And now it's 12.8. For Europeans, it was 3.7 last year, and it's 3.3 this year. For African Americans, it was 7% last year, and it's 6% now, so it's a 1% drop there. Asians only 1/10% from 3.6 to 3.5. Latinos from 5.1 to 4.5. So you can kind of see where that is going. We'll pinch that some of them will not go over, but employment by select industries over a month in thousands. roughly about the same in, let's see, in goods producing from 15, well, wait a minute, excuse me. Actually, goods producing was much higher. It went from 15 in September to 37. This is in thousands, incidentally. Construction was 9 in last year, and it's 26 now. Actually, manufacturing was 6, now it's 5, so it dropped a little bit. You're seeing some in manufacturing, some drops. We had pretty much expected this to happen. Retail trade 1.8. Now it's 11.5. Information at -8. Now it's at -3. So we can more or less forget about that one. Temporary health services at 10.5. That was last year. It is now it's creeping up at 12.4. Healthcare and social assistance at 10.2, and now it's 42.4. So quite a bit there. Leisure and hospitality at a -75. It's now at 21. So a little different situation there. And we went over the hourly estimates. Well, let's do this. The average hourly at 34.4. Now it's 34.5. The earnings at $26.51. Now it's $27.24. The average weekly earnings, it was at $909.29. It is now $939.78. Roughly about a $30 increase. Index here of aggregated weekly hours, it was at 102.3 last year. It's now 110.1. We're just sort of highlighting a few things here. Now, the household survey and the establishment survey both produce sample-based estimates of employment. Both have strengths and weaknesses. The establishment survey employment series has a smaller margin of error on the measurement of month-to-month changes than the household survey, because it's a much larger sample. Over the month, employment changes about 100,000 is statistically significant in the establishment survey, which the threshold is for a statistical significant change in the household survey is about 500,000. However, the household survey has a more expansive scope than the establishment because it includes self-employment workers whose businesses are unincorporated, unpaid family workers, agricultural workers, and private household workers who are excluded by the establishment survey. The household survey also provides estimates of employment for demographic groups. That's the household as the establishment. So, in other words, margin of error is smaller in the establishment month-to-month changes because it's a larger sample. And you have that, the household and establishment survey, but the household gives the extent of self-employed workers, etc. Why does the establishment survey have revisions? The establishment survey revises public estimates to improve its data series by incorporating additional information not available at the time of the initial estimates. Another question here, does the establishment include small farms? Yes, about 40% of the establishment survey sample is comprised of business establishments with fewer than 20 workers. Does the establishment survey account for employment from new businesses? Yes, monthly establishment surveys estimate includes adjustment to account for the net employment change, generated by births and deaths. Is the count of unemployed persons limited to just those receiving unemployment benefits? No. The estimate of the unemployed is based upon monthly sample surveys of households. All persons who are without jobs are actually seeking or available to work, including those amongst the unemployed. Does the official employment rate exclude people who want a job but not currently working? Yes. How can unusually severe weather? We talked about that in Florence and how it impacted. Won't spend any time on it. But nonetheless, that is the household survey. And let's go back here now as we roll along and got that part out. Let's see. Well, stock markets globally fall after, of course, the jobs report, and treasury yields are going up. The increase in non-farm payroll shown in September, likely from a Hurricane Florence impact on restaurants and retail payrolls, also showed a rise in wages. So they are going up there, and again, the whole idea of a jobs report being inflation report from old price at Ameriprise in Michigan. The Dow Jones Industrials fell 180.43 points, and the S&P lost 16.0 points, and the Nasdaq Composite dropped 91.6. Period. The Pan-European FTSE Euro First Freeland Index lost 0.86. Steep sell-off in Treasury bonds that started midweek pushed the yield to 7-year high. Waiting in also, the week has been a bloodbath for fixed income side of things. The 30-year Treasury reflected a 4-year high of 3.424, up 7 basis points there. And the 10-year benchmark, that was a 30-year, rose 3.248. That was up 5.3 basis points. That was late on Thursday. So a little bit of information here. The bond market, of course, is closed. We'd abandoned Columbus Day. Anyway, the currency market, the U.S. dollar weakened in a choppy trading. The dollar index fell 1/10. The euro was up 2/10 to $1.15. Basically, the yen strengthened at 0.17 versus the greenback at $1.13.37 here. And in Milan, the stock market was down 3.1, while in London, the DAX were off. We're off 0.95 to 0.14. And crude oil, let's see, it fell to $70.34. Oh, that's the American future. Brent crude at 84.16. We'll go over this a little bit later. We talked already about Russia and Saudi Arabia intervening in the market. Let me see. More pricing in a global demand there. The global benchmark Brent crude futures for December fell 42 cents. And I think we already talked about that. They are taking a pause after yesterday's sell-off. Okay. They did have a big sell-off there. I think this is a good time to go to Baker Hughes. Baker Hughes rig count, 1,052 in the U.S., 182 in Canada, and 1,004 internationally. International was down 4. In Canada, it was up 4. In the U.S., it was down 2. Change from last year, 116 in the U.S., up, and down 27 in Canada, and up 73 in the world. So that's basically where it is. Baker Hughes, a GE company. I guess we're pushing things here. We're not. New York Fed lowered its Q3, Q4 GDP growth. What they're doing here, U.S. gross domestic products expanding at a 2.27 clip in the third quarter, slower than the 2.47. These are projections calculated a week ago, as from the New York Fed's nowcast model. It projected GDP in the fourth quarter to grow at 2.8%, weaker than the 2.9% there. And again, these are projections. The trade gap increased at 6.4%, a 6-month high of $53.2 billion in August. That's the Department of Commerce. That was on Friday. An Institute of Supply Managers said its barometers on domestic service industry reached a 21-year peak. That was in September. Very interesting situation there. And we'll do the BBC and Bloomington. Let me just go to the Institute of Supply Management. We'll come back. Let's do the Atlanta Fed. This third quarter GDP growth viewed at 4.1%. Amortized in Q3, that is from the Atlanta Fed. They tend to be a bit more optimistic than some of the other Feds. Our only comment on that, if you did in fact have 4.1% growth, you'd be watching, that would be in Q3, you'd be watching Q4 and Q1 of 2019 for some adjustments. In other words, normally when you have higher peaks, such as, say, a 4.1, a little abnormal when you're dealing with, 2.5, 2.7, whatever it was, there tends to be some problems. Now, the GP Now forecast model on Friday, looking at that, a little different here. And this is the Atlanta Fed. I'm not sure if we can get it up here or not. We'll try and skate away to them. The Institute for Supply Management. Sometimes we have a little bit of a problem getting information very, very quickly out of them. And I didn't prepare this these... We'll just have to refer back to this later. Let me see. This is the Federal Reserve Bank of Atlanta, and this is released on the 6th of October. The latest forecast is 4.1%. The model estimates real GDP growth seasonally adjusted in the third quarter of 2008 as 4.1%, unchanged from October the 1st. Slight decline in nowcast third quarter real personal consumption expenditure growth, and I'll go ahead and just attach this fixed investment after its morning employment report from the Bureau of Labor Statistics, offset by a slight increase in the nowcast combination of government spending, net exports, and inventory investments in the third quarter. And it'll be updated on October the 10th. Nice graphic here, and that is all we have. We'll put this up on our Twitter feed and on the Cranston Analytics Facebook page. Anyway, we've taken care of that. This is Goldman Sachs. The oil petrol market could witness a moderate surplus in early 2019, according to Goldman Sachs. While upward price risk will prevail for now, fundamental data outside of Iran has not turned bullish. In our view, the bank note that was dated, we expect fundamentals to gradually become binding by early 2019 as a new spare capacity comes online. Saudi Arabia said there is higher initial inventory buffers heading into Q4 due to production surge in Saudi Arabia in June, output volatility in regions like Libya and Nigeria. It was 3/10 million barrels per day above expectation, and recent ships in Iraq's increase the likelihood of a ramp up in Kazakhstan. Upward scale pressures will prevent some now fundamental. Anyway, gradually becoming binding by early. We already read that. Sorry about this. Sometimes the old teleprompter. Prices were up on Friday as traders focused on U.S. sanctions against Iran's crude oil exports to tighten the global market. Potential issues of waivers on Iranian sanctions after both key indicator U.S. stance as well as a way to stem the ongoing unwanted rally in prices. The bank said its base case for Iranian oil volumes remain a loss of 1.5 million barrels per day. That's been in other estimates of as far as oil pricing, where it's going. Yes, other estimates basically about the same. So we will. And now we'll go to the BBC and take a quick look at the BBC, and maybe we'll. We have a big headline here. U.S. job hits a 49-year low. U.S. China are not invited to WTO reform meeting. And Italy, I guess we'll spend a little time here on economic. What's behind Italy's economic turbulence? Not sure about that one. Controversy surrounds the Italian government's spending plans have led to continual nervousness in financial markets. The budget set out by the country's coalition last month, which involves a greater spending than previously planned, has already sent Italian share prices lower and knocked the value of the euro. Why is it back in the news? The government took office after the election. That was in March of this year. Wanted to be able to deliver on the campaign spending promise, but to do that it needed to borrow more than predecessors were planning on. The plan sent to the European Commission by the last government envisioned borrowing this year equivalent to 1.6 of annual national income, GDP, declining to 9/10 and 2/10 over the next 2 years. That's because the budget that is very near imbalance by the end of the decade. The coalition is waggling over the figure for later years, but for 2019, they're airing 2.4%. but this isn't the upper limit for the deficit on the EU rules, 3% of GDP, so what is the problem? Yes, but there's another rule that total accumulated debt should be no more than 60% of GDP. Italy has more than twice that amount, and one way to get the total debt down is to lower the deficit. Couldn't Italy get the burden down with strong economic growth? In principle, yes. Economic growth means a rise in GDP more rapidly, so as the debt as a percentage of GDP declines. What is the Armageddon scenario? It's interesting they use that term at the BBC. There are two. One is default by the Italian government, a failure to repay a debt as they come due. The other is leaving the euro. Both possibilities were clear in the view of various stages with Greece, but the eurozone came through. The size of the Italian economy and the government debt burden that would be much harder to deal with. But neither is on the horizon with Italy, although the government borrowing is getting more expensive. It's much cheaper than the level seen as triggering the need for a bailout. Italy did get in to that territory in the worst phase of the euro crisis, but it's not close to that now. There are people in Italy who want to leave the euro, and there's a Pacific sympathy, the idea in the coalition government, right-wing coalition government. So that is where the Italians are, or where they are not, and the case for Italy. And let's go to Bloomberg very quickly here, and we'll go back to the BBC and do the markets. We have to have somewhere to do the markets. We'll do some from Bloomberg here. Let's do commodities from Bloomberg. We'll just do it this way. The Bloomberg Commodity Index up 2.4. It looks like here. And the UBS Bloomberg Index was up 0.03. The Reuters is up 0.27. The Reuters International down 1.64. Brent crude we'd already mentioned at $74.34. Oh, excuse me. That is the U.S. West Texas Intermediate. Sorry about that one. I had $74.34. That was up 1 cent. T-Boone Pickens still jumping for joy there in his retirement. Brent crude was down 42 cents, but still at $84.16. The gasoline index was down $1.43. Natural gas down 2 cents. Home heating oil on the NYMEX. This is all the NYMEX here. Down 74 cents. We'll get precious metals in here. Gold on the Econmics at $1,206.60. That was up $4. The spot was up $3.71. $1,203.63. Silver 5 cents. Yeah, $4.65. Copper was down $1.46. Platinum on the spot was down $2.28. Corn was up 75 cents. Wheat was up $3, and I wish they wouldn't have this in blue. Coconut, coconut. It was up $14. Cotton was up 10 cents. Live cattle down 22 cents. No pork bellies here. And let me see what we are doing here. Well, we're going back. What we're doing. And we did commodities. We'll do some more of the market here. We're kind of hit and miss on this. We've already given the Dow, so we won't go back to do the Dow again. We did the NASDAQ Composite. And we'll go to Europe. We did some of the Euro stockage here. Let's see, what were they? They were down 29.57. The FTSE was also down 99.8. The net change, the net charge there, the change 1.34. We'll be consistent here now we're doing this. The DAC at negative 0.1 on not 8. In France, they were also actually, yeah, they were down 0.95. In Spain, they were also down 0.65. So in all of Europe, they were down. If we go, we're starting out here in the UK, 0.35. In Germany, in the negative, that was negative 0.35%, and negative 0.08% there. In Asia, the Nikkei was also down 0.80. The tropic down 0.47. The Hang Seng was also down 0.19 in Shanxi. They were actually up there 1.04%. And let's see who else we have here. Another Asian Pacific down 0.71 there. That's the Asian Pacific MSCI. So we got Asia, we got Europe, and we've done the U.S. So we've done a pretty good job here of looking at all of these various sources here that we use from time to time. Well, we won't do this one. However, this is from Bloomberg. Housing prices are going for the roof in 10 major cities. We haven't talked much about housing lately, but again, the Bloomberg Global Housing Cost Index, which analyzes more than others 100 municipalities nationwide, worldwide. We won't use their index here. Toronto, Munich, Vancouver. A little not exactly what we wanted, but looking at rents, 3-bedroom apartment, avoid San Francisco and New York if you can. Downtown, go north of $6,300 and $5,700 respectively. Non-prime locations at $4,200 and $3,300. Amongst the top U.S. cities in the top 20, with Washington, D.C. dropping, Boston, Los Angeles, and Seattle rose amongst those. There will be a breaking point for employees forced to choose between sky-high rents and standard conditions of long commutes. Is likely to pick getting out of Los Angeles. That's from Mary Leslie. She's president of the LA Business Council, said in a statement after the council this week released a report on city housing. In Beijing, the financial hub of Shanghai, each moved into the top 10 this year. Hong Kong has a higher annual mortgage cost. Self-reported average rates for the cities on the mainland range from 5% to 5.5% this year. So there's some going on there. And 7 cities dropped more than 10 spots from last year. They include Dubai, Moscow, Istanbul, Rio de Janeiro, and Mumbai. So these are some of the cities here, kind of interesting here. Buenos Aires, Kiev, and they lead the Impossible Dream Pack. Well, I'm not sure what the Impossible Dream Pack is. Methodology, the Bloomberg Global city housing cost affordability index of more than 100 globally. Well, we may or may not attach this. I don't know. We'll have to think about it. Let's look at our time here going. We're running about right. Nonetheless, I'll round this up here. The employment situation is moving along comparatively well, but not, say, to the 90s. But remember, the 90s were 20 years ago, different situation there. Less globalized economy than today. That's one thing to remember. And comparing it to the 60s is way out of bounds. That leaves a very false impression, and this is part of the so-called American First, where you focus on the 50s and 60s. Totally a different situation. And one note here that you see, say, a rise in workers' compensation, wages, etc. There is one, but at the same time, inflation for what workers buy, the interest rate on mortgages, the rates on the credit cards, all that will go up. And we're not sure where healthcare in some states it's dropping. That's on the exchange. In other states it's not. And you have to look at all these factors to see where you are. In other words, if you get $1 in your raise, but if inflation is eating you up by 75 or 80 cents, you can see what's happening there. And it'll be very important this holiday season, because the big basic retailers are some of the things that ordinary people have to buy at the Walmarts and various other people, and even on Amazon. Because Amazon, since they're increasing compensation in some of their areas, and I'll try to next week's show get some scale as to what Amazon is doing. We don't have the gas rate, but pretty much it's about the same as last week. I'm just guessing off the top of my head. But this whole employment situation, yes, there are more people working. 1 percentage point, quite an extreme percent of African Americans working out there. And more teenagers, young people working, but at the same time we had increase in so-called part-time employment. So this is sort of a smoke and mirrors situation here, that it is better but not great. Now, as far as the 3.7% rate, that naturally, people assume that as the employment rate drops, say if it dropped to 3.5%, that there's very little opening out there, and it's true because there are very few workers in some areas to fill those. In other areas, there are workers to fill them, but are not looking because either they believe there are no jobs there, or jobs that are paid subpar rates, or companies that have jobs that are just simply not filling them, as some of the school districts are doing, because they cannot find workers because of the compensation mismatch. So those are some of the kinds of things that are affecting this whole situation out there. But as workers find out about the tight market, about increases, as the 31,000 steel workers, they will want a pay increase. And those things bring about some inflation. There's a trade-off there. Does the Fed run a modern capitalist society, economy at a greater than 2% inflation, say 2.5, which is fluctuates between that now, depending on how you do it, and perhaps even 3%. Now that is where the trade-off is. Because in other words, the job count there is low for September. What will happen in October and November as we finish out Q4. Q3 we've got, but as we finish out Q4, so the situation is there. The Retail Association is forecast, I believe, 4.1% on their retail sales for the holiday season, which will start next month. They run it almost 2 months now, instead of the old standard turkey and the drumstick day till when Saint Nick flies down the chimney, if you have one anymore. So those are the kinds of things that has changed. We didn't have the back-to-school deal. Then we have the automotive sales. We'll get back to those. However, new 2019 cars selling, some of the 218s and 217s are still hanging around showrooms. That is different. The construction industry, what they're able to do as we go in transition from fall into winter. In some areas of the country, they'll be out of business for a few months effectively. So that affects the economy. And, of course, the holiday shopping for Q4 and Q1. So we'll leave it at that. For those in business, make next week a productive one. For the consumer, obviously, keep your eye on the prize. Good day from us in the Jerry Pippin broadcast booth. Incidentally, we'll have an open source report this weekend and on Monday on our political side from WBGBN. Anyway, and the Bostonred Network will have the Monday morning quarterback. Period there. WBRN. Get our call letters right here. Transitioning back to many years ago when we were at different radio stations. Good day.